Attention YouTubers, I have a bribe for you. This is an extremely controversial video, and I need your help ranking it number 1. If you like this video, I'll send you a gift worth 1 Ethereum. If you leave a comment below, I'll send you a gift worth 2 Ethereum. If you subscribe to this channel, I'll send you a gift worth 10 Ethereum. And if you find the secret code slide hidden in this video, I'll double the bribe. And if that wasn't enough, if you'll also share this video on any social media site or blog, I'll quadruple the bribe. So what exactly is your prize? It's a free copy of Portfolio Builder's Long Portfolio, which helps you build an index of the top cryptocurrencies in the world with position sizes that are based on its 30-day trading volume. And later in this video, we'll talk about why that's the best strategy for deciding how much of each coin to own. Plus, you're going to get a free copy of Portfolio Builder's Short Portfolio, which helps you generate a profit when cryptocurrencies go down. Combined, it allows you to generate profits when the market's going up or down. Now we have 3 access levels. We have the basic plan, which costs 1 Ethereum. To get this, you just have to like the video. We have the gold plan, which you'll get for just commenting on this video, which normally costs 2 Ethereum. And then we have the diamond plan, which costs 10 Ethereum. To get a free 30-day trial to the diamond plan, you just have to subscribe to this channel. Now, if you find the secret code hidden in this video, you're going to get that doubled to 60 days. And if you share this video, you're going to get a 120-day free trial. Now, you will not get the crypto coins, which is our own cryptocurrency that real customers get. You're just going to get access to the platform for the specified time. So let's talk about the different membership levels so you can decide what makes the most sense for you. The yellow coins are our basic platform. They are all stored on a cold wallet called the Ledger Nano S. This is probably the most secure place in the world to store your coins. And because of Shapeshift's API and the recent purchase of Bitfract, you can actually send Bitcoin to bitfract.com, plug in our percentages from our calculator, and in a single transaction, fill this entire portfolio to build your index of the cryptocurrency market. The blue coins are part of our gold membership, and these are the coins available at Binance. So there's a lot of great technologies that are not included in the basic program, and this really takes your portfolio from around 25 coins up to 100. Our diamond members are getting even more advanced. We're trying to find the coins before they hit Binance, and this is primarily done by investing in Ethereum, dApps, and soon we'll also be adding EOS, Neo, Qtum, and other platforms who are creating dApps. Now you can actually go to our homepage, portfoliobuilder.io, and start the process immediately. If you just click here, without any credit card or any kind of crazy registration, we will instantly send you your spreadsheets. And immediately after signing up, you'll have the tutorials to get going right away. So you can start getting everything ready, installing our Chrome app, as well as gaining access to our membership area where we have loads of tutorials, how-to guides, security warnings, everything under the sun that you could possibly need to build an advanced cryptocurrency portfolio is all held within our membership site. And what's even cooler is that we have free coaching sessions. Absolutely free. You schedule it here. It's self-serve. It sets up a go-to meeting. We'll look over your shoulders and help you fill out your spreadsheet to get going. So there's a lot of tutorials you get immediately after signing up, and when you shoot us your email with your YouTube ID, that's when we'll extend your free trial to either 60 or 120 days and then upgrade you from a basic membership by default to a gold or diamond. So let's look at a few other features here real quick, and then we'll get back to our controversial video. But right here are the aggressive settings, your strategy settings. And depending on what you select here, it's going to dramatically change your target size for each coin. So if I pull up our back end of our software platform, this is where I'm controlling the popularity of each coin and artificially lowering Bitcoin's popularity as well as Ethereum's in different aggressive settings so that we can push more money into altcoins. So if we look at column H, I, and J, you can see in the conservative strategy on the basic platform we have a 57% position in Bitcoin, aggressive 43, and super aggressive 28. But when we go to the gold, those go a little bit lower, and the diamond even lower. That's because more money is being pushed down into all of these different coins. And so basically the way it works is you insert your deposit, go to the money manager, trigger an update, and then it's going to tell you exactly what to buy, what to sell to fill out your portfolio. If this looks like something cool that you want to try out at any point in this video, just go to portfoliobuilder.io. All the links in the top right-hand corner and the left-hand corner will lead to this homepage. Sign up for your free trial, and then immediately start watching all the tutorials of how to set up your software. Now, if you do want to get upgraded to the gold or diamond plan, just comment for getting the gold plan, subscribe to our channel for the diamond plan, and then if you can watch our video and find the secret code, we'll double you to 60 days, and if you actually share this video on your social media site, we'll give you 120 days free access. Just send your name, Gmail, and your YouTube ID to support@portfoliobuilder.io with the subject line, "I'd like to try the basic gold diamond portfolio," so we can quickly verify you. And again, if you just watch this video and like, comment, or subscribe, you can get the basic gold or diamond membership for 30 days free. If in your email you include the code that is revealed in this video, will increase your trial to 60 days. And if you send the link where you've shared this video, will increase your free trial to 120 days. We'll create a Portfolio Builder long and short portfolio and send it directly to your inbox. Give you access to our complete library of tutorials. Plus, you'll get my daily video newsletter where I detail any trades I make, what's happening in the cryptocurrency world, and much more. So what's so controversial about this video? Bitcoin is dying, and in this video, I'll prove it. It has the equivalent of cancer for humans, which is not great news for cryptocurrency enthusiasts. Bitcoin gave birth to this entire industry. And Silk Road, illegal or not, was the main website that initially drove use for Bitcoin. You can see right there on their homepage, step 1, get anonymous money. Step 2, buy something here. And step 3, enjoy when it arrives. Bitcoin has minted more billionaires and millionaires in less time than any other investment vehicle has ever done in history. And many people think of Bitcoin as the sun of the cryptocurrency universe, fueling the entire space. Bitcoin has proven to be hacker-proof for 9 years now, longer than any other cryptocurrency. As of writing this, Bitcoin stores $100 billion worth of value safely in its blockchain. That's more than 3 times the value held in Ethereum, the second largest cryptocurrency, and 10 times that of Bitcoin Cash. We all love Bitcoin. It's the brand name. It's the slogan. Bitcoin is the movement. Without Bitcoin, none of this blockchain jazz would be here at all. Yet I'm here to tell you Bitcoin has cancer and it's spreading fast. Bitcoin is mutating into a creature that will look nothing like the Bitcoin we all knew and loved. This isn't my opinion, it's just cold hard facts which will be exposed in this video. Let's look at the big picture of what's going to happen before I drill into the details. Were you into social media back when MySpace was the big one in the early 2000s? This is what their profile page looked like. It was slow, clunky, hard to use, and had annoying music auto-playing everywhere. But it was huge and used by everyone. It was the first on the scene and had the first mover advantage. Then Facebook came along with its slicker, faster, and more user-friendly platform. It took Facebook about 3 years to stop MySpace growth, and then 6 years to put them completely out of business. Bitcoin has the same exact problems that MySpace had back in 2005. It's slow, it's expensive, and there are better alternatives. Right now, Bitcoin can only support around 150,000 transactions per day without having high fees, $5 plus, and slow confirmation times, 3 hours plus. And we can see that right around January of 2017, this figure went to 300,000 transactions per day. And we all know what happened after that. Bitcoin's price flew up high, no one could sell, confirmation times went to very slow, and prices went extremely high. And we can see in December and January, as the transactions per day rose well above what Bitcoin can support, the fees, the median fee was between $5 as a low and as high as $30 at the peak. So when you combine high fees and 2 to 40 hour wait times, what do you get? You get a panic. What would you do if you couldn't sell your position for a day or 2 or 3? Bitcoin essentially breaks around the 2 transactions per second mark, locking up its entire network and sending fees and confirmation times to the moon. And in fact, in the past year alone, Bitcoin has lost around 1/2 of its market share. And you can see in July of 2017, Ethereum, for a moment, nearly had a larger market cap than Bitcoin. Do you remember when you used to go to the mall or local retail stores to buy things in person before the days of Amazon Prime? Hardly anyone does that anymore. Do you remember taking the kids down to Blockbuster to get some videos for the weekend? Not as easy as turning on Netflix, is it? When's the last time you used film to take a picture? Digital's a lot cheaper. Look at what happened to the China and Russian GDP per capita when they switched from a completely state-run economy controlling prices to adopting free market prices around the year 2000. Do you notice that the average income per person has skyrocketed for these two countries in the past 2 decades? So what's causing Bitcoin to be so slow and expensive? What's crazy is it boils down to a single digit in the entire Bitcoin code, which is the block size. And it's currently being limited to 1 megabyte. And you can see this wasn't a problem for all of Bitcoin's history until we reached a certain amount of usage. And in January of 2017, the block size for Bitcoin became too large, hit the 1 megabyte limit, and stunted growth, missing out on $20 billion worth of transactions and crashing the entire cryptocurrency market. And there's just one problem holding them back. A company called Blockstream has successfully spent millions lobbying against any changes to Bitcoin's block size. And one of their main shareholders is a huge, too big to fail insurance company with 1.439 trillion euro under management, AXA Insurance Company. The CEO of AXA has also been the chairman of the Bilderberg Group since 2012. And so what is this Bilderberg Group all about? Well, it's a very private annual meeting with 120 to 150 people. And historically, attendee lists have been weighted towards bankers, politicians, directors of large businesses, and heads of state. Wait, I thought Bitcoin was here to replace the bank's control over money. And here's a photo with Christine Lagarde, Managing Director of International Monetary Fund, next to Henry, CEO of AXA. Are you starting to smell the conflicts of interest? Until Bitcoin can rid itself of Blockstream, it will be plagued with high costs and very slow transaction speeds, simply because they won't allow Bitcoin to increase its block size. In a moment, we'll talk about why they don't want that to happen. But first, let's go back in history and talk about a guy named Gavin Andresen. He's a Princeton University graduate who was programming virtual reality software when he ran into a guy named Satoshi Nakamoto, the creator of Bitcoin. When Satoshi left, he publicly announced Gavin to be the lead programmer in continuing the mission. And this is back in 2012. By 2015, Gavin foresaw the problem coming to Bitcoin. And if you go to his blog, you can see and read these articles yourself. I've highlighted the important blog posts and his response to all the programmers who are essentially lobbying against increasing the block size. May 4th, 2015. Time to roll out bigger blocks. I was planning to submit a pull request to the 0.11 release of Bitcoin Core that will allow miners to create blocks bigger than 1 megabyte, starting a little less than a year from now. But this process of peer review turned up a technical issue that needs to get addressed, and I don't think it can be fixed in time for the first 0.11 release. Well, little does he know, there will be no updates to the block size. So he notes that he will be writing a series of blog posts, each addressing one argument against raising the block size or against scheduling a raise right now. Why increasing the maximum block size is urgent. Perhaps the most common objection I hear to raising the maximum block size from 1 megabyte is that blocks aren't full yet, so we have to not do anything yet. And it is true, we were not yet at the hard-coded 1 megabyte block size. On average, blocks are 30 to 40% full today. So if you remember that chart we were looking at in 2015, the average block size was around 300 to 400 kilobytes. But he foresaw what would happen. If the number of transactions waiting gets large enough, the end result will be an oversaturated network, busy doing nothing productive. I don't think that is likely. It is more likely people just stop using Bitcoin because transaction confirmations become increasingly unreliable. There's no need to raise the maximum block size because the Lightning Network sidechains impulse factum solves the scaling problem. If the maximum block size is raised, there will be little incentive for other scaling solutions to emerge. So these were two more critiques. The first is easy to address. If any of the other proposed scaling solutions were tested, practical, and already rolling out onto the network and being supported by all the various Bitcoin wallets, then indeed there would be no hurry to schedule a block size increase. Unfortunately, they're not. We are years away from a time when we can confidently tell a wallet developer, use this solution to give your users very high volume, very low cost, very low minimum payment, instant transactions. And now it's 2018, near the end, and guess what? There's still no Lightning Network rolled out. The second is also easy to address. The layer 2 services that are being built on top of the blockchain are absolutely necessary to get nearly instant real-time payments, micropayments, and high-volume machine-to-machine payments. To pick just 3 examples, the 10-minute settlement time of blocks on the network is not fast enough for those problems, and it will be the 10-minute block interval that drives development of those off-chain innovations more than the total number of transactions supported. Scheduling an increase to the maximum block size now is a short-term kick the can down the road fix. It's ugly, but necessary. Block size and miner fees. Again, I'm still seeing various forms of the argument for keeping the 1 megabyte block limit. The network will be more secure with 1 megabyte blocks because there will be more competition among transactions and therefore higher transaction fees for miners. Focusing on just the average fee term in that equation is a mistake. The number of transactions is just as important. If the goal is to maximize the number of transactions times the average fee, we would need to know the price elasticity of demand for Bitcoin transactions to calculate the most profitable for miner maximum block size. But the exchange rate is even more important, at least until the reward drops to 0. So if the goal is to keep the network as secure as possible over the next 10 or 15 years, we should be focusing on doing things that are likely to increase the exchange rate. All of the things that come to mind to make Bitcoin more valuable, like increasing the number of people using Bitcoin, increasing security using multi-sig wallets, and allowing people to innovate and leverage the security of the blockchain for things other than payments will be the benefit from a larger maximum block size. Will a 20 megabyte max increase centralization? Continuing with the objections to raise the maximum block size, more transactions means more bandwidth and CPU and storage costs, and more costs means increased centralization because fewer people will be able to afford that cost. And he says, I can't argue with that first part of that statement. More transactions will mean more validation costs, but how much? Is it significant enough to worry about? And so he goes through the math, and this is in 2015. They could easily raise the block size to 20 megabytes, increase the transactions per second by 20 times, and still run the full blockchain node with a $10 to $20 a month hosting plan. So it's clear that raising the block size was not going to be any of the problems that they really described. What was really, at the end of the day, is they wanted to create side chains for profit. Big blocks and Tor. I think the first time I heard this objection to larger block size was from Peter Todd. More transactions makes it more difficult to keep Bitcoin activity private from oppressive governments. That's hard to argue with. Obviously, the more you do something, the more likely you will get noticed. But engineering is about trade-offs. So how much more likely is somebody to get noticed by the oppressive government if they're using a Bitcoin system that supports 60 rather than 3 transactions per second? Well, if they're just transacting with Bitcoin using a lightweight wallet, there's no difference. Lightweight wallets, meaning any wallet except for Bitcoin Core, only download transactions relevant to them, so they are unaffected by changes to the maximum block size. I struggle with wanting to stay true to Satoshi's original vision of Bitcoin as a system that scales up to Visa-level transaction volume versus maintaining consensus with other core committers who obviously have a different vision for how the system should grow. 20 megabytes is meant to be a compromise, large enough to support transaction volume for the next couple of years, but small enough to make sure volunteer open source developers can continue to process the entire chain on their home internet connection on a modest virtual private server. If compromise isn't possible, then a simple dynamic limit intended just to prevent DOS attacks is a very attractive long-term solution. And the rest is history. The Blockstream's team successfully convinced the community to not vote for a simple block size increase so that they can privatize side chains for profit. And at this point, I want to play a video put together by Decentralized Thought. His YouTube link is in the description below. We have no affiliation, nor have we ever met or spoke. And this next segment will honestly blow you away. It illustrates in great detail what Blockstream is doing to turn Bitcoin into a fee machine. After that, I'll be back and we'll discuss which coins you should own. There's a lot.
Hey, you. You may have seen something about Bitcoin a few years back. It sounded revolutionary. This was going to replace the banks. It was permissionless, decentralized, peer-to-peer electronic cash. No one can take it from you. You can send any amount for less than a penny, fast. But damn, The price was $100, and it would probably fail anyways, so you better play it safe and see what happens. Then you saw the price recently on the news, $15,000, and immediately your stomach dropped because you realized that how rich you could have been, but you blew it. But you realize that it's still going up fast, and if you invest now, you're probably still on the ground floor. When you finally get your Bitcoin, after waiting 5 hours for it to confirm, you realize that some is missing. Turns out that your small investment of $30, $15 went towards the transfer fee to put it in your wallet. This is what was going to change the world? Let me fill you in on what happened while you were gone. Transaction fees have risen because of the block size. The block size is 1 megabyte currently and only allows for a few transactions per second to take place. Many more happen than this, so the people who pay the highest fee get to go first in line. On December 12, 2017, at the time I'm recording this video, the average transaction fee today was $24.40. This problem only gets worse with time and as adoption spreads. Instead of raising the block size again, the development team has decided to go for a second layer called the Lightning Network. It promises instant transactions, super low fees, and this is the basics of how it works. Let's say me and you transact regularly, so we open a channel for 2 Bitcoins. I send a Bitcoin and you send a Bitcoin to a multi-signature address, where it's temporarily locked away. Now we are free to trade 2 Bitcoins back and forth with no fees, as long as we both sign each transaction. This is because the actual Bitcoin was never moved. We are essentially trading for the rights of the coin, off-chain, similar to an IOU. When we close our channel, it settles on the blockchain. Our IOUs are redeemed, and we get our share of the real Bitcoin. The only time the high transaction fee occurs is when you open or close a channel to settle up. You want to transact with somebody you don't have a direct channel open with. Let's say you want to transact with Bob and pay him 1 Bitcoin. Bob does not currently have an open channel with you, and you don't want to have to pay the fees to open another channel. It turns out that my first cousin Sam has an open channel with Bob. You could send the payments through our channel and use the channel I have open with Sam, and finally from Sam to Bob, paying me and Sam very small transaction fees for using our open channels. This is ideally how the network would work, hopping from individual to individual until your transaction meets the intended recipient. But it turns out if Sam isn't as fortunate as us, and our channel only has 0.5 Bitcoins deposited, this won't work. There has to be enough loaded on each channel along the way for it to be used, and the network must find another route. Luckily, it turns out that Bob and you both eat at the same pizza shop regularly enough that you both have open channels. The pizza shop has plenty of Bitcoin in its channel and is 1 less hop than the last example. Bob gets paid, less fees for you, and the pizza shop gets a reward for providing a useful service. Everyone wins. Or so it would seem. A problem with the system is the requirement to preload every open channel you have ahead of time, with what you assume will be the upper limit of your spending habits with that channel. It's more convenient to have 1 open channel and a large amount of Bitcoin to a well-connected party that consistently has more money than you, so you can always route through. This is why hubs will naturally occur. A Lightning hub is a node with enough channels open and enough liquidity available that by connecting them, you limit the amount of channels you need to personally open, never have to worry about their balance, and reduce the amount of hops and fees required to make transactions. Unlike miners, who don't actually transfer value, these hubs will likely be classified as third-party settlement organizations, being subject to heavy financial regulation laws such as KYC and AML. Also, unlike on-chain transactions, there is a chance of theft in this system. If another party attempts to broadcast a channel in an old state, they can try to steal your Bitcoin if you can't catch them in time. For this, you will either need to run a full Bitcoin node that will always be online to monitor the transactions yourself, or hire a third-party service to do this on your behalf. So, the Lightning hubs will require to be set up for financial regulation and reporting laws, require massive amounts of liquidity to keep multiple well-funded open channels, offer fraud departments to watch the blockchain constantly and prevent theft, all while taking small fees for every transaction you route through them. Does this system sound familiar? Just replace the term open channel with checking account. These Lightning Network hubs will be ran by the same financial institutions the Bitcoin was made to challenge. The banks aren't fighting Bitcoin because Bitcoin will be the new banking system. Bitcoin needed no middleman. There was no fraud to detect, no permission to give, no transaction to reverse, no fees to collect. So it had to be broken to need them. And the worst part is, you won't have a choice. Either give up your freedom and use the Lightning Network, or be subject to double or even triple digit ever increasing fees for every move you make on the blockchain. The truth is, the 1 megabyte blocks restricting Bitcoin are purposely kept there by the developers. The absurdly high fees and long waits create a demand for a solution, and the solution they give us is the banking industry. The block size restriction was placed as a temporary safeguard by Bitcoin's creator, Satoshi Nakamoto. As soon as the blocks were close to being full, it was to be raised again. Satoshi mysteriously left the project in 2010, but before he did, he left instructions on how to raise the block size and left Gavin Anderson in charge of the project. When Satoshi left, institutional money started to make its way in and take control, and a company, Blockstream, emerged. Over time, it happened that a large portion of the development team was part of or hired by this company, and when it came time for another block size increase, there was a portion of the developers that thought this was a bad idea. This just so happened to be the same group of developers that worked for Blockstream. The story of how Blockstream took over is a long and strange one, and I'll have to cover it in another video. But with massive amounts of censorship, organized attacks, and manipulation, Blockstream managed to take primary control over the development of Bitcoin and forced out any of the developers who opposed their choices and gave open arms to the ones whose opinions are aligned. Ever since then, the fees have exponentially risen. The confirmation times have grown from minutes to hours to days, and the merchants are dropping support at a rapid rate. The block size should have been raised long ago. It could be raised for years without any risk of centralization, giving us time to find other solutions. But it won't happen, because Blockstream states that they plan to turn a profit by selling sidechains to businesses, allowing them to accept custom Bitcoin-backed chains that aren't subject to Bitcoin's high fees, taking small fees for every transaction, fixed monthly fees from the businesses, and selling the custom hardware needed to run them. This model is far more profitable if Bitcoin doesn't work properly. If the fees are low and no one wants their sidechains, then how will they pay the $74 million back to the corporations and big bankers who have invested, the ones who benefit from the Lightning hubs? This amazing technology, designed to give freedom, stability, and power to the people around the world, has been ripped apart and destroyed for power, control, and profit. Can big blocks scale? And if they can, would it centralize the network? First, let's take a look if it's even possible. Bitcoin currently only allows for a few transactions per second. It has 1 megabyte blocks about every 10 minutes. This equals to 144 blocks per day and 50 gigabytes per year of storage. This size has caused massive congestion in the network, raising confirmation times to hours or days, and the average transaction fee is $57 as of today at the end of 2017. An 8 terabyte hard drive currently costs only about $150, which could contain the next 160 years worth of the current blockchain. In order for Bitcoin or Bitcoin Cash to raise to the level of Visa, it would require a little less than 2,000 transactions per second. Without SegWit, this would require 300 megabyte blocks, equaling to less than 16 terabytes per year, or 2 of our $150 hard drives. All our transactions would be less than a penny, and without replace by fee, this allows for instant zero confirmation on small to medium purchases at worldwide adoption level. It's really that simple. The argument is that the cost of storage and bandwidth would cause some users not to be able to afford to run nodes and consolidate them to miners only. Let's explore this. Big blocks change the requirements of two resources, storage and bandwidth. Storage is easy. 16 terabytes per year of storage would only be needed at the height of adoption. This would take time. Even today, $300 a year would be affordable enough for most to run. After all, that's only 5 transaction fees worth of Bitcoin. But storage gets cheaper over time due to Moore's law. Let's look at prices per gigabyte over the past 50 years. In 1967, it was $1 million per gigabyte. 1980, $200,000. 1990, $7,000. 1997, 20 years ago, $450. 2000, $15. 2005, 64 cents. 2010, 10 cents. 2015, 5 cents. 2017, 2 cents per gigabyte. Technological innovation does not stop. By the time 300 megabyte blocks are required, this will be a non-issue more than it already is. So what about bandwidth? Bandwidth is an issue in many developing countries, but internet connectivity is also affected heavily by innovation and is spreading at a rapid rate around the world. Today, if Adbuki Adbani from Nigeria is already having problems with bandwidth, it's likely that his slow connection to his node is hurting the network and slowing relayed transactions from reaching full nodes to be propagated into blocks. Which brings us to the question, why does he need to run a node anyways? You often hear that nodes validate transactions, keep the network secure, keep miners from changing the protocol to their benefits, or are the integrated voting mechanism of Bitcoin. But this is only true for full nodes, that is, a node that has hash power behind it. Let's imagine a busy airport next to a hotel. The hotel is where the transactions begin, and the airport is the next blocks, where the transactions need to end up. Transactions need to be taken by the nodes and placed in a block. Transactions are the people, and the vehicles are nodes. The gas to run the vehicles is the hash power. Joe comes out of the hotel and needs to be taken to the airport. So he steps into the first taxi he sees, only to find the taxi can't move. It has no gas. So Joe steps out to try the next vehicle and repeats this until he finds a vehicle that is able to take him to the airport. This is how your node relays transactions. It's not relaying them towards the destination, but randomly passing it to another node in hopes that it has hash power behind it. The only node capable being a full mining node, but the relay was never needed. Joe could have stepped straight out of the airport and into the proper vehicle without the trouble of hopping from one to another. If your vehicle spots something on the road, it can do nothing about it. You can't drive to alert anyone or change anything. You are stuck dead in your tracks with an empty tank. Saying everyone in the world should have a car is meaningless if you do not have the gas to power it. Your node isn't performing its function. This is where the confusion is, because in the Bitcoin white paper, nodes all have hash power behind them. It wasn't until later that the mining function became optional, and your node could be read-only, to be used as a wallet. This was before SPV wallets were available. People think that their nodes are helping to secure the network, but they're not. Like the taxi, they are just sitting there waiting. Without the hash power, your node acts like it was never there. Any validation, rejection, or confirmations it might make have no impact on what the miners or the pools do. It only receives the block information after the true full nodes have done their job. If your node rejects a block receiving from the mining node, it is just forking itself off the network. It doesn't fix anything. Bitcoin is a proof-of-work system. If you do no work, there is no proof, and you get no power. If non-mining nodes had the power that people believed, someone would easily whip up 10,000 nodes on cloud servers to perform a cyber attack. This doesn't happen because without the hash power, the nodes have no influence. This is not a design flaw. This is a great strength. Non-mining nodes do serve a purpose, but it's the purpose not for the network, but for the operator of the node. It allows you to have a copy of the ledger that is already validated by real full nodes. It allows you to independently verify zero confirmation instant transactions. If there was a situation where the miners colluded into a 51% attack or double spend, it would allow you to see it. But you still couldn't do anything about it. This makes it useful for businesses accepting Bitcoin to run these nodes, not users. As Satoshi said, users should use SPV wallets. Have you ever heard anyone talk about the lack of security and reliability of SPV cold wallets like Trezors or Ledgers? No, they are above secure. The issue is not that nodes could potentially be consolidated. The issue is the lie that regular users should have to run nodes. Let's look at some of the quotes from Satoshi Nakamoto, the creator of Bitcoin himself. The current system, where every user is a network node, is not the intended configuration for a large scale. That would be like every Usernet user runs their own NNTP server. The design supports letting users just be users. The more burden it is to run a node, the fewer nodes there will be. Those few nodes will be big server farms. The rest will be client nodes that only do transactions and don't generate. At first, most users would run network nodes, but as the network grows beyond a certain point, it would be left more and more specialists with server farms of specialized hardware. A server farm would only need to have one node on the network, and the rest of the local area network connects to that one node. Only people trying to create new coins would need to run network nodes. People have been fed a lie that running these worthless nodes somehow does something good for the network. But why? One reason is that it gives the illusion of decentralization while contributing to the process of centralization via second layers. People are fighting tooth and nail to contribute to this system because they believe it's the right thing to do. Secondly, with the introduction of SegWit, relay nodes are needed to relay the segregated signatures from the transactions. Core has created the need for a party that has no financial incentive to do so. By fooling you, you keep their broken system running. Bitcoin is supposed to be a system regulated by incentives, but now relies on trickery and lies. Worthless wallet nodes were never supposed to and not required to be a distributed part of the system. And I understand the sentiment. Just as I wish I could be a miner, we all want to be part of the system. But don't let sentiment blind you to be a burden. On-chain scaling is the long-term, simple, affordable solution and could be implemented today. It was planned from the very beginning, but the protocol was purposely blocked and destroyed in order to place financial institutions as required middlemen for the new system to run. Feel free to disagree with me, but first read the white paper. It's obvious that this was foreseen and never a problem in the first place. If you disagree with me, let me know in the comments. Tell me how your node is going to keep anything in check. How is it going to enforce anything? How can it stop the evil miners from doing anything? You've been lied to, so you can relay segregated signatures for free to allow the banks to be middlemen. Welcome to the harsh, cold reality of greed and power. There is a problem with the Lightning Network. It doesn't scale, or at least the way we need it to. If you've seen my last two videos, hopefully you understand that routing with the Lightning Network isn't as straightforward as one would expect. It can be summarized into two main issues. One, the Lightning Network is in a constant state of extreme change. Channels are constantly opening and closing, nodes going online and offline, channel states being updated with funds sliding from one side to another. Routing paths may be open and available 1 second, and unavailable or completely gone the next. And two, your node has to be the one that goes through all of this data, find all of the available paths, take into account the number of hops, relay prices, then compare every path and eliminate the possibilities down until the optimal path is found for your payment. This entire pathfinding task is handled by the sending node, which is in most cases either a laptop, smartphone, or Raspberry Pi. And unlike a blockchain, there isn't a network history stored. The network must be mapped from scratch every single transaction. So we eventually hit a ceiling. There's too much data, too many nodes, channels, and change for your hardware to be able to process. Where the ceiling is, we can't be exactly sure. But to quote Rusty Russell, one of the Lightning developers at Blockstream, there are protocol scaling issues and implementation scaling issues. All channel updates are broadcast to everyone. How badly that will suck depends on how fast updates happen, but it's likely to get painful somewhere between 10,000 and 1 million channels. Link in the description. The unknown gap between 10,000 and 1 million channels is pretty wide. It's recommended that each node have around 14 open channels to stay decentralized, and each user must run their own node set. So assuming the average channel count of a user is around 10 or so, the Lightning Network's maximum user base is anywhere between 1,000 and 100,000 users. Coinbase, a single Bitcoin exchange, can have 100,000 new user registrations in a single day. The optimistic maximum user capacity for the Lightning Network is around 1 day worth of new users. What about the users from the past 10 years and all the new users signing up each day? Routing sort of works now because we're at the lower end of the possible capacity, and users are opening very few channels each. But in the very near future, as the network grows, it will come to a screeching halt. Routing is still completely unsolved. Even the Lightning Network white paper, which is 57 pages long, doesn't even touch on how this will be done. Routing is summarized in a single paragraph that simply states that routing is theoretically possible, without any explanation on how this may be done. Blockchain research company Bitfury wrote a separate white paper on an improved routing method, Flare, which is 38 pages alone. Flare scales to around 100,000 users as well. Routing is just one of the many unsolved problems that Lightning has. It's a very long way off from being able to handle any meaningful number of users, if it's even possible to do in a decentralized way. After years of being constantly told that the Lightning Network is just around the corner and just to wait a few more months, users are starting to realize that Lightning as an off-chain scaling solution is not quite what it's purported to be. The status of the Lightning Network being unable to scale off-chain to meet any user demand raises an interesting question. Why has the Bitcoin Core team completely stopped on-chain scaling? If off-chain scaling is struggling to scale up to a single day's worth of new users, even after 3 years of active development, why then have they become the focus of the BTC chain? Every attempt at raising the block size in the past several years have all been shut down immediately or delegitimized with no compromise. Could it be that on-chain scaling is being halted for other reasons? That's the topic of another video, the conflict of interest in Bitcoin development, how for-profit corporations plan to profit using third-party scaling. Let's talk about Blockstream. Blockstream hasn't been around for as long as many think, only being founded in 2014 by Adam Back and made public in 2015. Now employing most of the active Bitcoin Core developers, this new corporation has nearly complete control over Bitcoin Core, Bitcoin's single development team. Notice that I said corporation. Blockstream isn't a foundation. It isn't community-funded, donation-based, or even self-funded for that matter. It's a for-profit company with products, employees, and investors. But how does a for-profit company profit from developing a peer-to-peer decentralized cryptocurrency that is designed to have no intermediary roles to pull profit from? Well, you create them. Adam Back, Blockstream CEO, states, Blockstream plans to sell sidechains to enterprises, charging a fixed monthly fee, taking the transaction fees, and even selling the hardware. End quote. Sidechains are a separate blockchain that is pegged to Bitcoin's value. You send one Bitcoin to a smart contract and receive a new coin on the sidechain. Coins on the sidechain can differ from Bitcoin in just about any way. They can have better smart contract capabilities, offer instant transactions, or anonymity features. But the key difference between sidechains and the Bitcoin blockchain is that transaction fees don't go to the miners. They go to the developers of the sidechains. This should set off some major red flags.
These profitable sidechains fill in the gaps of what Bitcoin is not capable of. The more Bitcoin is capable of, the less sidechains will be used. And the more limited Bitcoin is, more profit can be pulled by more users needing to use the sidechains. Blockstream doesn't make profit on what Bitcoin can do. Blockstream makes money on what Bitcoin cannot do, while in control over Bitcoin's development. This is a clear conflict of interest. You can take this to two extremes. One, if Bitcoin scales perfectly on-chain, has reliable instant transactions, and general smart contract capabilities, there will not be a need for sidechains or second layers. The company will have no source of income and will eventually fail. Or the other extreme. If Bitcoin can't scale on-chain, has unreliable transaction times, high fees, no smart contract capabilities, there will be endless ways to profit from Bitcoin's shortcomings. And we all know what has happened since 2015. Bitcoin's block size has not been raised. Transaction fees fluctuate wildly. Confirmation times are completely unreliable. Zero confirmation instant transactions were removed. The opcodes allowing smart contracts were also removed. All on-chain progress has been halted, other than compatibility upgrades for the integration of second layers. All while Blockstream has been working on their second layers like Liquid and Lightning. Second layers on the Bitcoin chain are really more accurately described as fee harvesting layers, attempting to restore the original functionality of Bitcoin while redirecting fees and decision-making from the miners to the developers. Blockstream's need for these fee harvesting layers was further increased when they began raising investment money, taking a total investment of over $80 million from large institutions such as AXA Strategic Ventures and the Digital Currency Group, which have considerable ties to MasterCard, the Federal Reserve, the Bilderberg Group, and various other central banking entities, raising further questions to the motives and ethical nature of those in charge at Blockstream. It's clear that their values are no longer in line with the original Bitcoin community, which is why most of them have left the BTC chain.
So is Blockstream's goal to generate profit or to increase the value of Bitcoin?
So we actually have Green Address also. It's a the consumer wallet,
right.
the mobile wallet. But yeah, largely right now all of our stuff is free. We're mainly focused on R&D. We have been very focused on R&D. We'll have Liquid coming out early next year, hopefully, fingers crossed. And that will be a commercial service that will generate revenue. But the goal is everything will generate revenue. It's not just we're going to build stuff for free forever.
Yeah.
So even for Blockstream Satellite.
Okay, I'm back. Thanks again to Decentralized Thought for his presentations on Bitcoin and Blockstream. And this slide pretty much sums it all up. This is again Blockstream's main developer. And this is not really his quote, but this is someone mocking him. Yes, we must limit the block size to the same it has been for 7 years. The average user needs to be able to run a Bitcoin client on their Raspberry Pi because centralization is bad. Although a 256 gigabyte SSD costs $100 on Amazon, and the miner reward currently sits at over $40,000 per block. And the transaction cost has gone from pennies to several dollars for the average user. And the transaction confirmation is unstable and unreliable. And half the market capitalization has left Bitcoin for altcoins since I took over as king of Bitcoin. We at Blockstream don't want transaction growth because that would mean people are using Bitcoin. So we'll keep the blocks small and full to prevent that. This is best for Bitcoin. Centralization is bad, so Bitcoin must not grow. Transactions must be expensive so the average user can afford it. Any questions, fools? So you're saying that Bitcoin Core is fighting centralization and censorship with centralized hubs? Blockstream is taking Bitcoin in the opposite direction as Satoshi's white paper. And the headline again is Bitcoin, a peer-to-peer electronic cash system. Not a store of value, but a cash system. That means fees need to be very, very low. And what's beautiful about all this is that Satoshi designed Bitcoin to easily fork if something like this happened. And it did. We now have Bitcoin Cash with 8 megabyte blocks. And down in the photo below, you can see Blockstream wants to create the Lightning Network, which will create tolls every time you do a transaction, while Bitcoin Cash has an 8-lane highway. It's fast, it's nearly free, and can continue to increase its block size as needed. Bitcoin Cash is what I started working on in 2010, a store of value and a means of exchange. This is from Gavin's Twitter, November 2017, right before the crash. It's hard to imagine a cryptocurrency world without Bitcoin as the king. So, assuming that Blockstream continues to ruin Bitcoin, who might push to the top? Roger Ver, an original Bitcoin investor who made hundreds of millions, really likes Bitcoin Cash, but he's also diversifying his money into just about every good-looking technology out there. And he has a good quote: "My $20 per month home internet connection can support 300 megabyte blocks, so let's raise the block size limit." The currency that has the fastest times with the least fees while not losing security is likely to become the winner. Now, do I think Bitcoin will never go above $10,000 again? Not at all. In fact, I expect Bitcoin to be pumped hard in 2019, as it's about to be added to the stock market as an ETF. Huge trillion-dollar banks are quietly loading up on Bitcoin, and I expect they will be propping prices and trading volume through the roof very soon. However, as Bitcoin's prices rise, smart investors will be selling their Bitcoin into better technologies via altcoins. Altcoins will grow in value exponentially faster than Bitcoin, and they can due to their current market caps being much lower and their trading volumes being much lower. Also, there's no futures market constantly challenging their prices. Do you remember it took 3 years for Facebook to stop MySpace's growth and 6 years to put them out of business? So other than Bitcoin Cash, where else might you want to invest your money? Real quickly, the secret code to include in your email to support at portfoliobuilder.io to double your free trial length is the Bitcoin white paper title, a peer-to-peer electronic cash system. So again, just add that code to your email and we'll double your free trial. Back to the strategy guide video. Which coins should you own? Don't look for the needle in the haystack, just buy the haystack. John C. Bogle. Warren Buffett bet $1 million a decade ago that the S&P 500 stock index would outperform hedge funds. And not just any hedge funds, only the best hedge funds. This is the exact strategy Portfolio Builder teaches investors. And guess what? He won that bet. The S&P 500 kicked the average hedge fund's butt. It's just too hard for individuals to outsmart the collective intelligence of the total market. So stop trying to guess which cryptocurrency will be the next big hit. You nor anyone else has a magic crystal ball. All you need to do is follow the money trail and build an index of the market. The more trading volume, the more you should own. It's that simple. Take small positions early and grow your positions as the coin's popularity rises. Money talks and bullshit walks. It's not the other way around. You only need one indicator: trading volume. Trading volume for cryptocurrencies is like profits for companies. Forget Bitcoin's price. Let's take a look at Bitcoin's volume growth over the years. In 2013, it had almost no registered trading volume. In 2014, the price quadrupled as trading volume reached $5 to $16 million a day. In 2015, the trading volume rose to $10 to $30 million. despite the price dropping. In 2016, the price shot back up as the volume jumped to $50 to $92 million a day. By 2017, the price more than tripled as trading volume went to $500 to $700 million a day. And now in 2018, the price is much higher, trading $8 to $10 billion a day. And so from all this demand growth, Bitcoin has added a zero every 2 years. From 2009, trading at 0 to 2011, 10, 2013, 100, 2015, 1,000, 2017, 10,000. Will it reach 100,000 by 2019? We shall see. So if you just track trading volume, you won't be fooled by price action. And that's important because in the short run, the market is a voting machine, but in the long run, it's a weighing machine. If trading volume is dying, the coin is also dying, and you should reduce your exposure. If the trading volume is growing, you should buy more and add more exposure. Look at how fast Ethereum's trading volume has grown. In 2015, trading at $1, it traded less than $5 million a day. In 2016, it rose to $10 and traded between $5 to $15 million a day. In 2017, it shot up to over $350 and traded between $500 million to $1 billion a day. And in 2018, it's trading at $450 with $1.5 to $2.2 billion traded a day. The same is true for Ripple's trading volume. 2013, half a penny with no trading volume. 2014, nearly the same price per token, but trading volume was rising, 250,000 a day. The price barely nudged up by 2015, although trading volume pushed to over $300,000 a day. By 2016, the price was still firm at half a penny, yet trading volume rose to $1 to $2 million. By 2017, the price skyrocketed to 17 cents and began trading $50 to $100 million a day. And by 2018, it's trading anywhere from $2 to $8 billion with a price of over $3. Now, Portfolio Builder determines its position size by looking at each coin's 7-day trading volume. The more a volume, the bigger the position. And as the volume changes, we're dynamically changing your target size. So the big question out there right now, is this a good time to buy cryptocurrencies in general? Can you guess how much Amazon crashed during the dot-com burst? It actually crashed 94%, going from $100 to $5.5 over a 2-year bear market. But overall, Amazon's gone up 120,500% over the past 2 decades. So let me ask you again, is now a good time to invest? Let's look at one of the big reasons to invest in cryptocurrencies in the first place. And that big reason is that although our wages are staying relatively the same, our purchasing power of the US dollar and other government currencies is losing value. And the reason it's losing value is because governments are spending more than they make and just printing money to finance their budgets and obligations. And you can see over the past 2 decades, global debt is rising to all-time highs. And there's no stopping the governments. The deficits are going to continue to get worse until something snaps. One of the biggest liabilities to all countries are their government pensions, representing more than their GDP. The problem is that the people electing the leaders will never vote for someone who's going to take away all of their benefits. Meanwhile, companies are sucking money out of the economy with bonds and losing tremendous amounts of money to build their businesses. A prime example of this is Netflix, losing $4 billion in 2018. But there's so many credit crises brewing, it's hard to keep track without a scorecard. The mother of all credit crises is coming from China, with over $250 billion owed by insolvent banks and state-owned enterprises, not to mention off-the-book liabilities of provincial governments, wealth management products, and developers of white elephant infrastructure projects. And then there's the emerging markets credit crisis, with Turkey and Argentina leading a parade of potentially bankrupt borrowers vulnerable to hot money capital outflows as a slowdown of growth in developing economies is ripping money out of risky emerging markets and back into the United States. Close on their heel is the U.S. student loan debacle, with over $1.5 trillion in outstanding debts and default rates approaching 20%. And we're also facing a devastating wave of junk bond defaults. The next financial collapse, already on our radar screen, will quite possibly come from junk bonds. We're in the middle of a great government and corporate debt bubble, a tsunami of unlimited special interest cash. And so what has this done to the price of gold? Gold has been in a 50-year bull market ever since we left the gold standard. Alan Greenspan, in the absence of the gold standard, there is no way to protect the savings from confiscation through inflation. Meanwhile, we can see Bitcoin has been growing exponentially. The more money they print, the faster Bitcoin, gold, and all cryptocurrencies will rise. And if we look at the big scheme of things, Bitcoin is still tiny, with around only $100 billion market cap. Gold, the most similar asset to Bitcoin, is an $8 trillion market cap, whereas the total global debt obligation is $164 trillion. So is it any wonder that the big bankers' message to young people would be, stop trying to create money? You've never played banking? It's easy. First you give me the ball, and then I charge you every time you want to play with the ball. I'll also charge you if you want to give that ball to someone else, and a small monthly fee for holding onto your ball. So with Bitcoin at depressed prices, here are some words of wisdom. Warren Buffett: I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. But before you go all in on Bitcoin, beware. Bitcoin will underperform the total index. And if we look at this, you can see that as the market cap of Bitcoin grows, its price growth is likely to slow down and begin to flat out. But let's look at a little evidence that other technologies, other cryptocurrencies can outperform Bitcoin over periods we may be entering right now in 2018 and 2019. Let's look at the first half of 2017, when Bitcoin went up 120% from $1,000 to $2,200. Ethereum went up 2,287%, going from $8 to $191, outperforming Bitcoin by a factor of 19. Ripple went from half a penny to as high as 40 cents, and then later up to $3 for a 6,566% return, outperforming Bitcoin 54 to 1 just in the first half of 2017. Litecoin returned 540%, going from $5 to $32, and it's pretty much the exact same thing as Bitcoin. Stellar returned 2,180%. Monero only outperformed Bitcoin by 2 to 1, going up 240%. Dash went up 1,172%. Ethereum Classic went up 1,100%. NEM went up 7,122%. Altcoins will outperform Bitcoin by a huge factor. So where are all the big players buying the best coins today? There's really only one place. It's called Binance. They're the top exchange in the world. You may have seen the Forbes article, but Binance may bag $1 billion in profits by the end of 2018, despite the market going down and losing most investors' money. The Binance CEO claims to have 10 million users, and that figure is likely closer to 12 million as this video is being recorded. Zhao became known for building high-frequency trading systems for the stock market before launching Binance in 2017. A year ago, Binance didn't exist. Today, it has a lightning-fast exchange that can handle 1.4 million transactions per second. And now it costs $3 million just to list your token on Binance. Every big-name blockchain technology is currently trading on Binance, and it's where our Portfolio Builder Basic and Gold membership targets 100% of its investments. The position sizes are dynamically calculated daily by their popularity. And right now, there are over 120 top coins you can purchase from Binance. So what do all of these different coins do for the cryptocurrency ecosystem? I'm going to skip the well-known ones like Bitcoin, Bitcoin Cash, Litecoin, and Ethereum. Those are amongst the biggest positions in our index. But let's look at the coins you're probably missing out on right now. EOS traded $628 million, has a market cap of $7 billion, trading around $8, ranked number 5 in market cap. EOS has gone from 57 cents to as high as $18 so far for a maximum gain of 3,050%. It's a blockchain startup that raised $4 billion without a live product. So what does it do? The most powerful infrastructure for decentralized applications. EOS is a direct competitor to Ethereum, and they have some major differences. One big difference is that EOS tries to build the actual subsets of libraries used to develop applications, whereas Ethereum wants other developers to build these application sets. EOS uses a delegated proof of stake, while Ethereum uses a proof of work. EOS is fast, with 10,000 to 100,000 transactions per second, while Ethereum is relatively slow. The ownership of EOS tokens gives users a proportional stake in the network bandwidth, storage, and computing power, while Ethereum uses miners. The arguments between EOS and Ethereum go well beyond the scope of this video, and while Ethereum is a surefire winner at this point, EOS is certainly a technology that has to be in our portfolio and on our radar. Cardano, ranked number 8, $82 million traded in the last 24 hours when shooting this video, market cap of $3.9 billion. Cardano has gone from 2 cents to as high as $1 for a maximum 4,900% return. A cryptocurrency is more than the sum of its protocols, source code, and utility. It's ultimately a social system that inspires, enables, and connects people. Frustrated by the many half measures, failures, and broken promises of past protocols, we set out to build something better. Generation 1 was Bitcoin and money transfer. Generation 2 was Ethereum and smart contracts. Generation 3 claims that's what Cardano is. Hoskinson's actually helped build Ethereum, left that project to build Cardano. And while this project is still very early in its stages, it claims it can solve three major issues: scalability, interoperability, and sustainability. Tron, rank 11, $193 million traded in the past 24 hours with a $2.4 billion market cap, a very excited Reddit group with 6,500 active subscribers. Tron has gone from 0.002 to as high as 24 cents for an 11,900% maximum return. It's boasting many of the same features that Cardano is, with speed, scalability, and trust, and its main marketing sales point is decentralizing the web. In this chart, we can see that its transaction growth and address growth is on the rise. And they also just bought BitTorrent for $140 million. And here's a photo of their very handsome-looking team. Tron is an ambitious project dedicated to the establishment of a truly decentralized internet and its infrastructure. The current Tron team radiates out from Beijing to Seoul, Tokyo, San Francisco, and many other countries and regions, totaling more than 100 members. IOTA, rank number 9, $42 million traded in the past 24 hours with a $3 billion market cap. IOTA has gone from 30 cents to as high as $4.50 for a 1,400% maximum return. And this is yet another competitor to the mainstream blockchain technologies, promising high scalability, fast transactions with low costs. IOTA has ditched the concept of your normal blockchain and created a technology called Tangle. Tangle essentially makes every person using the blockchain a point of reputation where you must approve several transactions prior to your transaction, thus making its technology much faster, decentralized, and feeless. IOTA grows via transactors, not miners or stakers, thus avoiding centralization. IOTA is aiming to be the backbone of the emerging machine-to-machine economy of the Internet of Things, data integrity, micro-nano payments, and other cases where a scalable, decentralized system adds value. Binance Coin, rank 17, $51 million traded in the past 24 hours with a $1.4 billion market cap. Binance Coin has gone from $1.18 to as high as $24 for a 1,933% maximum return. The Binance Coin is expected to fuel the operations of the Binance Exchange and its ecosystem. It supports multiple utilities on the Binance ecosystem, which includes for paying for trading fees, exchange fees, listing fees, and other fees on the Binance Exchange. And they're also buying back with their profits the Binance Coin, which is what has been driving its price up. Ontology, rank 30, $51 million traded in the past 24 hours with a $545 million market cap, 744 Reddit readers. Ontology has gone from $1.50 to as high as $9 for a 500% maximum return. So what is Ontology? Ontology is a new high-performance public blockchain project and a distributed trust collaboration platform. Ontology provides new high-performance public blockchains that include a series of complete distributed ledgers and smart contract systems. Ontology supports the collaboration among chain networks with its various protocol groups. Icon, rank 27, 31 million traded in the past 24 hours, 23,000 readers, and a $570 million market cap. Icon has gone from $1 to $12 for a 1,100% maximum return. Icon is a massive platform that will allow various blockchains to interact with each other via smart contracts. The project wants to hyperconnect the world by building one of the largest decentralized networks in the world. Dash. Dash is a revolutionary digital money system. Its key benefit is privacy. Lisk, a cryptocurrency that enables developers to build decentralized applications using JavaScript. Your blockchain made simple. Lisk's sidechain development kit makes it easy for you to build your own blockchain. Our tools are free for everyone, open source and written in JavaScript. Discover your potential with sidechains. Amigo, a cryptocurrency enabling financial inclusion and interoperability through the public OMG network. Next generation financial network and decentralized economy. The OMG network is a scaling solution for finance on Ethereum, enabling transparent peer-to-peer transactions in real time. NEM, a cryptocurrency that uses proof of importance and supernodes to enable quick transactions and reliability. NEM is much like Ethereum, but built to be faster with a different strategy for verifying transactions. Dogecoin. This coin's biggest thing is that it's not trying to be anything special. It's just an established currency for trading and sending money to your friends online. It has a popular phone app that already allows you to do this. Digibyte, a security-focused blockchain. Digibyte is 40 times faster than Bitcoin, with a 4-year track record, and boasts to be the most secure blockchain. Monero, a privacy-oriented cryptocurrency that anonymizes transactions using stealth and ring signatures. Monero is a decentralized cryptocurrency that is secure, private, and untraceable. Neo, a platform that uses a DBFT consensus model to enable smart contracts. Neo is a blockchain platform and cryptocurrency designed to build a scalable network of decentralized applications. The base asset of Neo blockchain is the non-divisible Neo token, which generates gas tokens that can be used to pay for transaction fees generated by applications on the network. And advantages it may have over Ethereum include it's faster, uses less energy, cannot fork, supports multiple programming languages, and perhaps has a more advanced consensus mechanism for coming to decisions. Qtum, a smart contract platform that can interoperate with smart contracts on other blockchains. A decentralized open source smart contract platform and value transfer protocol. Ripple, a cryptocurrency enabling faster and cheaper bank-to-bank transactions. Specializing on banks, using XRP, banks can source liquidity on demand in real time without having to pre-fund accounts. Ripple has been expanding into banks very rapidly and is extremely fast, as shown in this comparison chart. Stratus, the native token for accessing the Stratus Enterprise blockchain as a service platform. We offer simple and affordable end-to-end solutions for development, testing, and deployment of native C+ blockchain applications on the .NET framework. Their biggest advantage is simply that they allow developers to leverage their current C+ and .NET programming. Verge, a privacy-oriented cryptocurrency that uses I2P and Tor to anonymize transactions. Privacy as a choice, a secure and anonymous cryptocurrency. They recently partnered with Pornhub. Vertcoin, a cryptocurrency built to resist ACIC mining and thus centralized mining control. What is Vertcoin? Vertcoin is a cryptocurrency like Bitcoin and Litecoin, with an added focus on keeping the ecosystem as decentralized as possible. Cryptocurrency is worthless unless it's decentralized. Currently, Bitcoin and Litecoin have the majority of their hash rate owned by large mining conglomerates in China. This is far from safe. Vertcoin was created in 2014 with the intention of being easily mined by the masses. Stellar Lumens, a cryptocurrency focused on cross-border payments. Another cryptocurrency claiming to have the speed and trust issue solved with one cryptography strategy. Status, a cryptocurrency enabling an ecosystem of decentralized apps, messaging, and payments. And they actually just released their chat app a few weeks ago for making this video. Zcash, a privacy-focused cryptocurrency with the option to create completely anonymous transactions. They call it a Z-Snark. VeChain, 49,000 Reddit viewers. VeChain has gone from 25 cents to as high as $7.50 for a 2,900% maximum return. VeChain is a blockchain-enabled platform that is designed to enhance supply chain management processes. By utilizing tamper-proof and distributed ledger technology, VeChain provides retailers and consumers with the ability to determine the quality and authenticity of products that are bought. So now you can track the entire history of where something came from, been to, and arrived at. Gifto has gone from 25 cents to as high as 75 cents and is a relatively new coin made popular by a site called Twitch, a gaming site which gamers are making millions from. Gifto allows you to send virtual gifts to content creators. And they're currently in phase 2. Pundi X has gone from half a penny to as high as 1.5 cents for a 200% maximum return. They are creating these devices and putting them in retail shops around the world. A recent headline was that a Hong Kong retailer added their point-of-sale payment system. By 2019, Pundi aims to have installed around 50,000 units. Power Ledger has gone from 5 cents to as high as $1.82 for a 3,450% maximum return. So what is Power Ledger? It is a blockchain-based peer-to-peer energy trading platform enabling consumers and businesses to sell their surplus solar power to neighbors without a middleman. Basic Attention Token, BAT, 18,000 Reddit followers. This coin has gone from 20 cents to 75 cents for a 275% maximum return. Basic Attention Token radically improves the efficiency of digital advertising by creating a new unit of exchange between publishers, advertisers, and users on the blockchain. Users will earn BAT for their attention and be entitled to up to 70% of the ad revenue for any ads displayed to them. Self-Key, 2,600 Reddit followers. Self-Key is a blockchain-based self-sovereign identity system that allows individuals and companies to truly own, control, and manage their digital identity. Nebulous, NAS, 5,000 Reddit followers. This coin has gone from $2 to as high as $14 for a 600% maximum return. It's a new blockchain, and simply put, it's aiming to be the search engine for blockchain. And it was created by the founder of Neo. Zalika has gone from 6 cents to as high as 18 cents for a maximum return of 200%. And it is the first public blockchain designed to implement sharding, allowing for linear scaling as the blockchain grows in size. Mainframe. Mainframe has gone from 18 cents to as high as 24 cents for a 33% maximum return. It's a brand new coin. Mainframe is the platform for decentralized applications resistant to censorship, surveillance, and disruption. Walton Chain, 20,000 Reddit followers. Walton Chain addresses the bottleneck problem of the business application of the blockchain to incorporate physical assets into blockchain automatically. Loom Network. Loom has gone from 10 cents to as high as 60 cents for a 500% return. Also a brand new coin. Loom Network is a layer 2 scaling solution for Ethereum that is live in production. It is a network of DPoS sidechains, which allows for highly scalable games and user-facing dApps while still being backed by the security of Ethereum. Now, will all of these coins be winners? Hell no. Do you remember the 2000 dot-com crash? 50% of the tech companies went out of business by 2004. But thanks to Amazon, Google, Facebook, and other tech companies surviving the dot-com bubble, the NASDAQ is back to nearing all-time highs once again. So it's really simple. As trading volume grows for a cryptocurrency, increase your position. And as volume drops, decrease your position. This is what the Portfolio Builder Gold level does automatically for you. With Portfolio Builder Gold, you can count on owning a position in every major cryptocurrency the same day it becomes tradable on Binance. And they have new listings all the time. Then you'll learn how to store your largest position safely outside of Binance in a Nano Ledger S. Now let's talk about our diamond level portfolio builder. Introducing IDEX.markets. IDEX is the most popular anonymous and decentralized exchange which specializes in allowing you to buy Ethereum dApps and initial coin offerings. dApp stands for Decentralized Application, and currently the leader in dApps is Ethereum. The entire point of Ethereum is that it will allow developers to build decentralized applications of nearly everything you can imagine. For example, imagine a social network like Facebook that wasn't controlled by a centralized CEO such as Mark Zuckerberg. Facebook recently lost $120 billion in market cap, more than the total market cap of Bitcoin as of writing this, as people are not happy with the way Facebook's taking advantage of its users for profit. For the first time in history, its user base is descending. Twitter's supposed shadow banning of prominent Republicans is another example of a corporation using censorship. Twitter, shadow banning prominent Republicans. Not good. We will look into this discriminatory and illegal practice at once. Many complaints. YouTube has now warned YouTuber Alex Jones, who has 2.4 million subscribers, with termination because of the content he's publishing being against their terms. Amazon deleted over 900 negative reviews of Hillary Clinton's book, What Happened, which they deemed fake. Whether you're a Democrat or Republican, this video isn't meant to persuade you in either direction, only to point out that as voices become censored, they will find new platforms to express their views. How would you like a news source that isn't censored for either party? Right now, you can count on almost every source of news to be biased. How about a review platform that can't delete anyone's review for any reason? Or search results that haven't been manipulated? What about a social network that would pay its users the advertising revenue generated instead of shareholders? Do you think that a decentralized search engine or social network would allow the government and advertisers to spy on your private messages and search data? I could go on and on about the unethical practices of large corporations that's driving this movement. But this is what dApps are all about, and they're going to be huge. IDEX.markets is the go-to location to buy these dApps, being developed way before they're hitting Binance or other major exchanges. Here are the leading coins that began as Ethereum dApps: EOS, Tronix, VeChain, Binance Coin, Amigo, ZRX, Zilliqa, Icon, Eternity, Maker, Bytem, Reputation, BAT, Golem, PundyX. The list is much longer than this, but you get the point. All of these tokens could have been purchased very early on, before they went big on Binance. Now, it is important to note that Ethereum isn't the only dApp platform in town. EOS, Cardano, Eternity, District OX, Ethereum Classic, Lisk, Neblio, Neo, NEM, Qtum, Status are all competing in the same space. However, their dApp tokens to purchase are extremely limited right now, so we won't add these to our Diamond portfolio until they have a developed marketplace to purchase their applications. As of making this video, our Diamond level program only purchases Ethereum dApps, but EOS, Neo, and Qtum will likely be the next 3 dApp platforms we will expand into. So let's take a look at the most popular dApps today to give you a feel for what's already built and alive. Unfortunately, we're nowhere near providing mainstream solutions to replace popular services we discuss like Google, Facebook, Twitter, or even the news. I'd guess that we're a decade away from mainstream decentralized applications actually being built and becoming popular. Here's the biggest true dApp, which was not an ICO, for Ethereum to date. It's called CryptoKitties. What are CryptoKitties? CryptoKitties is a blockchain-based virtual game that allows players to adopt, raise, and trade virtual cats. The game was made by Vancouver-based blockchain company Axiom Zen. However, what is truly important to remember is that this is the first known application of dApp for leisure and recreation. Sales of CryptoKitties have been through the roof. People have spent more than $12 million buying these CryptoKitties. And here is a chart of their sales to date. Ethereum's founder, Vitalik, had a comment: "I actually like the digital cat games. They illustrate very well that the value of a blockchain extends far beyond applications that would literally get shut down by banks or governments if they did not use one." We're clearly still in the very early stages. The bigger success story for Ethereum has been its ability to raise capital for initial coin offerings, basically just application or blockchain ideas which weren't built upon selling the token. EOS, for example, a direct competitor to Ethereum, used the Ethereum platform to raise over $4 billion. This is yet a great example of Ethereum not censoring a competitor, claiming they can do everything Ethereum does but better. Other coins, which we've already discussed for the most part, include Tron, Binance Coin, Omigo, VeChain, Walton, OX, Icon, Zilliqa, Maker, Bytem, Augur, Golem, PundyX, Status, KuCoin Shares, Populous, Archain, Mixin, DigitDAO, iOS Token, Aeon, Elf, Loopring, Moek, Nebulous, Funfair, Power Ledger, XPlay, Wax, Dentacoin, Monaco, Kin, 10x, Decentraland, CyberMiles, Bancor, Polymath Network, Enigma, Knowles, Quash, Substratum, Gifto, Veritasium, Theta Token, Salt, Storm, Dragon Chain, Chainlink, these were all Ethereum dApps. So the big question now is, are you ready to join the Bitcoin revolution by building yourself an index of the entire market? Leave a comment below and we'll be in touch to give you a 30-day free trial to the Portfolio Builder platform. Thank you for your time, and if you really enjoyed this video, please subscribe to our channel.